What's going on, traders? In today's video, we're going to talk about trend lines and key levels. We're going to talk about why they're so important and how to draw them and find them correctly. Because a lot of beginner traders, they think that trend lines and key levels are much more subjective than they really are. And in reality, that's not really the case, because after a few years of studying price action and studying the chart, immersing yourself in it, you will start seeing a lot of similarities, and there is a specific type of way how trend lines can be found and how key levels can be found that I'm going to share with you guys today, and hopefully it will clear a few things up. Now, the market and these candles, they're always, in some sort of trend. Even in trading ranges, they're just tiny micro trends up and micro trends down, but this is the reason why we want to draw the trend lines. Market geometry is very real, and trend lines allow us to find and predict where the market is most likely going to be heading, because a lot of times price is bouncing off certain areas, and without the proper line, we have no idea why the price is bouncing off these areas. We even have the 21 bar exponential moving average on the chart, which helps us to identify the direction, but there's a reason why price keeps turning from these points. We cannot move the market, we're following institutions, and we want to use every single tool we have. Now we're going to start with the big patterns, big trend lines. The biggest trend line is the strongest key entry point and takes precedence. And every single time I'm drawing the trend line, I have few things that I keep in mind. And how do I draw the trend lines? Normally, you will draw your bigger trend lines off the first two swings. All right. So let's take a look right here. As we have a move up, move down, and move up, price resembles a trading range structure, but there is a bullish bias. We keep making higher lows. So I'm going to locate the bigger trend line. So what I can do, I can draw a trend line like this, use first two swings, put it at the top, and I see structure like this. So when I'm drawing my bigger trend lines and I'm looking for the bigger patterns, I always keep two things in mind. How long it's going to take for price to get all the way up to here, all the way down here? Is it even reasonable? I'm going to be waiting multiple hours for price to get all the way up to here to down here. And if price make it all the way down here, by the time this correction is going to be way too strong, it may even be a brand new downtrend, and I'm probably going to get trapped down here. So every single time the trend is starting to look too flat and is starting to look too much like a trading range, that's when I'm starting to get really cautious, because what I want to do, I want to draw my trend lines steep, because that's how trends are. Trends are not supposed to be flat, they're supposed to be steep, they're supposed to be going higher in one direction. And take a look how this makes sense much more. I can make it all the way down to here in a few minutes, and even the correction down to this trend line is going to be reasonable. There's still going to be a strong bullish bias. So this is what I keep in mind. And the same thing to the downside. I can use first two swings, but I have to ask myself, is this too flat? How long it's going to take for price to get all the way up to here? Does it make sense? All right, if price makes all the way up to here, it's probably going to be way too bullish, and that's not really going to be helpful. So this is what I keep in mind. I don't want to draw it too flat, I want to draw it reasonable, and this is how I do it. Now, a lot of times you will not be able to find the trend lines from the swings with the direction of a trend, meaning a lot of times you will be able to find a trend line from the lows if you're looking for uptrend, and from the highs if you're looking for downtrend. But there's a little tip I'm going to share with you. A lot of times you can find the trend lines before everybody else if you look for the trend lines from the upper side. Let's say in uptrend, and you guys can see, I will find a trend line off these highs, copy it, put it down here, and I can see that I can get the bounces all the way up to here. All right, so not every single time you're going to be looking for trend lines off the lows. Keep an eye how market geometry is reflecting at the top of your trend line. You will just copy it, put it at the bottom, and you will be able to predict where the price is going to bounce up here. Okay, now since we're talking about bigger patterns, what can happen is when the trend is strong and it's a strong trend day, a lot of times the corrections are so weak, the buying power is so strong that you will not even get it and make it down to this key entry point. And that's okay. You still want to have the bigger pattern on the chart because it serves as a bias confirmation. You want to remind yourself that the bias is strong, it's still bullish, and you're still wanting to be looking for reasons to go long. Okay, so this can happen during strong trends. A lot of times it will not even come into play, or you have it here just for the bias confirmation. Now, let's talk about the short-term trend lines, because this is where traders really struggle. They're mistaking whether they should draw the trend line tight or slightly wider. And we need to understand that once there is a bigger trend established, I'm going to draw every counter correction, I'm going to draw them micro, tight, steep. All right. So if there is a bullish uptrend working higher and I see a bunch of downtrends, what I'm not going to do, I am not going to draw wide like this. Even though this can still make it a little bit safe and keep you away from a few bad setups, you will deprive yourself of a lot of high probability setups if you keep playing it like this. All right, same thing up here. I'm going to draw it tight like this because right now this is a bullish correction, part of the bearish downtrend. I'm not going to draw it wide like this because I'm going to deprive myself of a possible good entry. Once again, we have a bearish downtrend working lower. I'm not going to draw it like this. I'm going to draw it tight like this because the overall pattern is down and this is just a correction. All right, let's take a look at this uptrend. I already have a bunch of them drawn right here, so I'm just going to quickly delete them. And what I'm not going to be doing, drawing them wide like this. I will completely get rid of every single opportunity to buy. Remember, the bigger pattern takes precedence and the trend is up, and I'm looking for reasons to go long. So I just want to make it tight enough so I can see when there is a break and a new extreme. All right, there's a break, new extreme right here. There is a nice break and new extreme down here. This is why we look for trend lines, because after there's a break, an attempt to create a new extreme, that's how we know that the downtrend played out. Sellers are no longer in control and we are safe to be looking to go long. Okay, so this is why and where we are looking to make them tight. Now you can see that you have a break and attempt to make a new low. You don't have a new extreme. And is that okay? Yes. A lot of times the trend is going to be so strong that you're going to only get an attempt for price to create a new extreme, and close is close enough in price action. You will never get anything 100% perfect. Sometimes it's going to be a little bit unclear, and since there's a strong bigger key entry point, price just cannot push it lower. All right, there's a lot of buyers in here, so you have an attempt to create a new extreme and that's enough. Same thing up here. You have a downtrend working lower, you have a break, you have a first attempt to create a new extreme, pull back higher, second attempt to create a new extreme, and it failed. Two failed attempts. This is the second entry short with the direction of a bullish trend. This is going to be a trap because second entry with the direction of a trend is a high probability setup. This is a second entry against the trend. Same thing up here. There is a new low, first entry short, pull back, second attempt to sell, failed above the EMA with the direction of a trend. All right, so this is a high probability setup because it's second entry short against the bullish long trend. So keep them tight, don't widen them too much. With the direction of a trade, you will deprive yourself of a lot of good setups. All right, and trend EMA is going to be so strong, trend is going to be so strong that a lot of times you will not get the clear break. A lot of times you will. You have a clear break, clear new extreme, cookie cutter, easy price action setup. Doesn't get much easier than this. All right, but a lot of times you can get attempt to make a new low and that's going to be enough. Now, where do we draw them a little bit wider? We draw them wider basically when it's unsure what the pattern is and when we expect a reversal. We also, I'm going to still mention a little bit the tight ones. In trading ranges, you almost always want to follow the tight trend lines. All right, so let's take a look at this. It's going to be a little bit different here because the structure is spike and a channel. We have a spike, we have a channel, we have an overshoot, and overshoot a lot of times lead to a break of a trend line or straight up reversal. So when I see this, I expect reversal for the market because this is not a correction. There is no bigger pattern yet. This is looking like a range-like structure. So what I'm not going to do, I'm not going to draw it like this. What I'm going to do, I'm going to draw it like this. I'm going to make it slightly wider. And I have a break, new extreme, which indicates that the downtrend played out. At the same time, I'm not going to draw the trend line like this. This would indicate that this bullish correction is part of a bearish downtrend. It's not the case here. I have to draw it a little bit wider like this because this is a new trend in itself that it's starting after this downtrend played out. Alright, this trend is not part of bigger downtrend. So I'm going to draw it a little bit wider like this. When it comes to shortened trend lines, we can draw shortened trend lines with the direction of a trend. And I'm not too fan of this. Not that it is not useful. It can only help us to draw the shortened trend lines with the direction of a larger pattern. But it's not really going to give us results as we are looking for. Because if you draw the shortened trend lines with the direction of a trend, you will keep making new extremes, and it kind of lacks the value of why we are looking for trend lines. We look for trend lines because we want to see a break, new low, and we want to see that the downtrend played out. If we're going to keep drawing the trend lines with the direction of a trend, it can only help us. It cannot hurt us, but it's not really going to produce good, powerful results, because a lot of times there's not going to be high probability setup at the shortened trend lines, because high probability setups happen at the key entry point EMA or the larger pattern. You cannot have a high probability setup far away from key entry points at the very top of the moves. All right. So I know that a lot of traders like drawing the shortened trend lines with the direction of a trend. Me personally, I think it's a little bit redundant. I like to keep my chart clean. I like to focus on the bigger pattern and on the corrections. That's all I need, and on the exponential moving average. So that's when it comes to shortened trend lines with the direction of a trend. Now let's talk about the overshoot. Overshoot is a break of a trend line, but with the direction of a trend. This is an uptrend, and we broke with the direction of a trend to the upside. This is the downtrend, we broke with the direction of a trend to the downside. All right. Overshoot is unnatural activity in the market, and it leads to break of a trend line or possibly straight up reversal. And that can mess up with the trend line rules, because after price will break the trend line, traders will attempt to create new extreme. But when it comes to overshoot, you can have straight up reversal without break and a new extreme. And this is crucial. This is what you need to keep in mind when you see overshoot, because you can be stuck on the wrong side of the market. All right, so just take a look at it. Today was really unusual. We had a massive move up, overshoot to the upside, massive move down at the same time, overshoot to the downside. This really doesn't happen too often. You had an overshoot right here to the upside and massive sell-off. So weird day when it comes to overshoots. But let's talk about overshoot and larger pattern. When it comes to shortened trend lines, overshoot is a no-brainer. You cannot probably mistake it. But when it comes to larger pattern, when you have an overshoot and you keep overshooting, you're basically thinking about, is this overshoot valid, or is the bigger pattern and big trend strong that there is no overshoot? And in this instance, this is what I did. We had a trend line like this, and we kept overshooting. So I put it at the top like this, and I made it slightly larger because I was betting at the bullish uptrend. Same thing down here. I made a trend line like this because I was betting at the downtrend, and it was not correct. Why? Because I don't have any prior point of reference, any swing that would confirm at least one. I need at least one, and it should be the second. I need some sort of confirmation at the top. I have no confirmation down here, and this can really lead to taking setups at these points, which is not the way you want to do it, because I really should have been treating it as an overshoot. And when it comes to this downtrend, it's pretty hard to find the downtrend. I'm going to use a two-tiered measure. I'm going to use the measure thing. I'm going to treat this as an overshoot. Shortened trend line, break new extreme, and price never look bad. It can actually look back all the way down here. But this is what overshoot are doing. Keep in mind that they can completely reverse the market. All right. Now let's talk about key levels. How do we look for key levels? Because what we can be doing, let's say we can mark key level right here. We can find key level up here. We can find key level up here, and we can find key level up here. And if you're going to be doing this, you're going to go nuts, because you could be doing this the entire day, and that's not really the way to do it. as intraday scalpers, the only key level you need to pay attention to is the one you would find during your pre-market analysis. You mark your low for the day and you mark your high for the day. And the reason why we look for key levels is because most breakouts from these key levels are going to fail. You never want to buy the breakout in this breakout phase. You want to wait for price pullback because most breakouts will fail, and you want to buy the breakout pullback or the sell. So remember, never trade with the direction of a breakout in this breakout phase. Wait for the pullback. Most breakouts of trading ranges and from these key levels are going to fail. That's number one. Number two, a lot of times price will retest these areas throughout the day. You guys can see this is the key level. Price broke strongly at the key level, pulled back all the way up to this key level. This is a breakout pullback pattern, retest of this breakout area, and it gave you a high probability setup. And all you need is to mark your key level during your pre-market analysis. Same thing, you mark this low right here and it comes into play all this late. You're far away from EMA, you have an overshoot, and you touch to the very tick the key level. This is why price is bouncing here. All right, this is the tool that you can use to help you to predict the trades. The key level is respecting the area right here. This is looking like a wedge pattern. You don't want to be taking trades in this. I took the second entry long right here, new high, first entry long, second entry long. I really was supposed to be sitting on my hands because I don't like taking trades in the wedge. But look what happened. It stopped you out and it took off exactly where you thought it was gonna go. First entry long, second entry long, failure. They trapped so many shorts here and it was a nice trap, but that's sometimes what happens in trading, but no big deal. All right, so remember key levels. You don't have to be looking for key levels during the day. Your pre-market analysis is going to produce high for the day and low for the day, important key levels. Of course, the price is going to be creating strong support and resistance throughout the day. Of course, you're going to mark it, but you don't have to be worrying too much about it. All right, so if I take a look at this day, I'm going to mark my key levels up here and down here. What I can see, the price broke higher, pulled back, and came back all the way down here to retest the breakout area. And remember, it is not a single line, it is an area on the chart. This is a retest of the breakout area, and all you had to do is find the key level during your pre-market analysis. Lows didn't come into play. All right, doesn't matter, the highs came into play. Let's take a look at the previous day. I'm going to mark my highs for the day. I'm going to mark my lows for the day. Highs for the day are reacting, price is turning down. Low for the day, support is forming, breakout area, price pulls back, retests this breakout area, and it gives you a high probability setup. And all you have to do is mark your low for the day, high for the day during your pre-market analysis, and you don't have to keep worrying about multiple key levels on the chart, because I see it, a lot of traders, especially in Forex, they mark 20 key levels on a chart and they're wondering why the trades are failing. I'm going to mark my key level up here, key level down here, let's say. You guys can see price is reacting to this key level and reacting to this key level at the bottom. Here I'm going to mark the lows, I'm going to mark the highs. Highs didn't really come into play, but the lows, strong breakout, retest of the breakout area. This is what you need, the key level. It will come into play. Once again, I'm going to draw the key levels up here, and it came into play all the way down here where you're far away from EMA, you're overshooting the downtrend, and this is where the price is bouncing. It helps you to locate the high probability areas. All right, I don't like having a thick lines like that on the chart. I will draw these thin lines so I can have a nice clear chart. All right, so this was additional video about trend lines. Hopefully it was useful. You guys can see we have an overshoot which leads to a break of a trend line or possible straight up reversal. You guys can see you have a downtrend, you have a break, new extreme. I'm going to draw my correction wider. I'm not going to draw it tight like this. Why am I not going to draw it tight like this? Because you already have a break and a new extreme. I even like trend line a little bit tighter, like this. Alright, so I'm going to draw a little bit wider. You have a break, attempt to create a new extreme, and you just now created a new extreme. And we're bouncing off the important key level, which is not even today. Alright, so if the video was useful, hit the like button, subscribe to the channel, and I'm going to see you guys in the next one. Take care, buddy.